Good morning or good afternoon, ladies and gentlemen. My name is Lukman. I would like to welcome everyone to FXTM's Week Ahead Market Themes to Watch Out For. Now, before we proceed, I would like to confirm if everybody can see my screen and hear me clearly. Just want to double confirm if everybody can see my screen and hear me clearly. Okay. What we're going to discuss today. So for those who are new to the FXTM's webinar, what we normally do is have a review of the markets last week, because I feel it's quite important to just have a recap of what's happened, because such things could impact what we see in the week ahead. There's going to be a breakdown of the economic calendar, and this will be followed with technical and fundamental setups. If anybody has any questions during the webinar or after the webinar, please be free to ask away. So a review of the markets last week. Last week was another big week for financial markets. We can say that the market mood brightened thanks to trade optimism. So we saw a wave of positivity sweeping across financial markets after China unexpectedly issued tariff exemptions on US goods. Now, to many people, this was seen as a olive branch, something that would ease trade tensions between the world's two largest economies. Now, Trump also signaled an interim deal ahead of the talks in October, so optimism over trade tensions between the United States and China boosted appetite for risky assets, and this resulted in global stocks, emerging market currencies, emerging market assets pushing higher, while safe haven investments such as the Japanese yen, gold, and bond markets suffered the blow. The major risk event last week was the European Central Bank meeting. So the ECB is the latest addition to join the global easing train. Back in 2020, Mario Draghi said he will do whatever it takes to support the euro, and during his last meeting as ECB president, he did whatever he could to support the eurozone economy. So the eurozone, the European Central Bank, cut interest rates by 0.1 basis points, dragging the deposit rates to 0.5%. They restarted quantitative easing starting from the 1st of November with the asset purchasing to $20 billion, and this is indefinite. They also did over some tweaks to the LTRO and a two-tier system. Overall, it was a very dovish meeting, and it did signal that the European Central Bank was doing what it could to stimulate the Eurozone economy. However, markets were expecting more. So initial market expectations were traders were looking for a 20 basis point rate cut in the deposit rate, the quantitative easing to be 40 billion, not 20 billion, and just more aggression in the central bank's dovish stance. This is why, even though the euro traded lower after the ECB decision, prices later moderated, rebounding, basically retaining all the losses. Across the Atlantic, the dollar has been pulled and tugged by mixed US data. So last week, yes, core inflation surprised by rising 2.4%. And how it works is any signs of rising inflationary pressures will reduce market speculation over the Fed cutting interest rates. However, on Friday, we saw retail sales which painted a mixed picture. Market was expecting a 0.2% rise in retail sales. We saw 0.4%. So it wasn't good, it wasn't bad, but when considering how retail sales For the previous month, July was 0.7%. It is showing slow signs in the world's largest economy. In the United Kingdom, the pound has regained some of its mojo based on the fact that there is some optimism over a no deal not happening on October the 31st. The reason is because the no deal Brexit bill has gone through and markets are seeing probably Boris Johnson may not be able to walk the walk after talking the talk. And when you're considering how economic data from the United States has also been impressive despite concerns over Brexit pushing the United Kingdom into a technical recession, appetite towards the pound has increased. Finally, looking at commodities, gold struggled to stabilize above that psychological 1,500 level. Now, this is a point that we've been talking about for an extended period of time. The reason why gold prices were under pressure last week was because of the improving market mood. Now, the reason why the market mood was improving was based on trade optimism. I'm still bullish on gold regardless, because even though we do have this short-term period of trade hopes, when we look at the bigger picture, when we look at global growth concerns still remain elevated. We still have geopolitical risk factors across the globe. You just need to look at Brexit. You just need to look at the European economy, look at Germany. There's signs of a decelerating momentum in the world's largest economy. Just look at China as well. So short term, gold does have the potential to push lower, but when we're looking at the medium to longer term, bulls have nothing to worry about. Okay, so just let me recap once more. The European Central Bank joins the global easing train by cutting deposit rates by 0.1% and restarting quantitative easing. The market mood brightens on trade optimism. Dollar pulled and tugged by mixed US data. Pound strengthens as no deal Brexit fears fade. Many are still asking if the United Kingdom will actually crash out of the EU on October the 31st. And gold struggles to stabilize above the 1,500 level. Okay. So loaded, I have the economic calendar on what to expect in the week ahead. So data-wise, today is relatively quiet, but due to the events we saw over the weekend, revolving around Saudi Arabia and oil prices, this is what everyone's talking about today. But data-wise, there's nothing big happening in the markets. On Tuesday, we have the monetary policy meeting minutes from Australia. So we know that Australia has cut interest rates to record lows at 1%. In Australia, when we look at the fundamentals, combination of slowing economic growth, falling house prices, subdued inflationary pressures, absent consumer spending. So when we're putting all these pieces of the puzzles together, the outlook for the Australian US dollar is bearish, but there will be a strong focus on the minutes, because if the minutes do suggest that there's further signs of the central bank cutting interest rates, the Australian dollar is set to weaken. On Wednesday, United Kingdom, we have inflation figures. So markets expect inflation to actually cool to 1.8% from the previous 2.1% seen in the other month. Now, this is quite interesting because when we're looking at the pounds quarter-to-date gains, the pound still remains one of the sick men in the G10 space. So it'll be interesting to see how this plays out. I understand that the pound has been appreciating over the past few days, last week, and a bit in the week before, but overall the pound still remains weak, and as we know, a weaker currency does result in rising inflationary pressures. If inflation does continue to moderate, this should open the doors for the Bank of England to cut interest rates. This year, I don't know, but January 2020 does seem like a possibility. Also on Wednesday, we have the FOMC statement and press conference. So it's a foregone conclusion that the Federal Reserve will move forward to cutting interest rates by 25 basis points. Now, I think what everyone's more concerned with is what Jerome Powell has to say. We've got mixed economic data in the United States. We have, yes, that layer of uncertainty over trade developments, lingering concerns of a slowing global growth. So what investors would like to confirm is whether the rate cut that we experienced last month was a mid-cycle rate cut, or if there's going to be more rate cuts down the line. Now, if Powell does sound very dovish and expresses concerns of the health of the US economy, this should pave the path to deeper rate cuts in Q4 and in 2020. Naturally, this is negative for the US dollar. On Thursday, the Bank of Japan meet. It's widely expected that nothing is done on the monetary policy note, but let's see. With Japan, with the Japanese yen, the yen is still considered a trader's best friend in times of uncertainty. And when we're looking at the Japanese yen's performance in recent days, okay, last week the yen did weaken thanks to the improving market mood, but overall, the elevated levels of uncertainty across global markets continue to support appetite for the Japanese yen. So there's four key themes I'll be looking out for in the week ahead. So, of course, the major talking point across markets is oil prices. Oil prices have soared 20% earlier this morning after the attack on the Saudi Arabia's oil refineries. Okay, after the 20% appreciation, it has given back 10% of gains. However, the last time, this is the biggest ever intraday move on record, and it's the worst disruption ever seen. Let me share numbers with everyone. So the attack has caused a disruption of 5.7 million barrels a day, which is roughly 50% of Saudi Arabia's production. Saudi Arabia produces around 9.6 million barrels a day. And when we're looking at the figures even further, this accounts for almost 5% of global supplies. So it is quite understandable why oil prices are trading at such elevated levels. Now, there's three questions on the mind of investors. Number one, how fast can supplies recover? Are there going to be further attacks? And what is the wider geopolitical implications? So the first answer to question one, how fast can supply recover? Well, earlier this morning, there were guesstimations about it taking a few weeks. Now we're speaking about a few months. All I do know is the longer it takes for Saudi Arabia to get back to optimum production, the stronger the possibility of oil prices pushing higher as supply shocks and concerns over undersupply in the markets encourage investors to purchase WTI crude. Can further attacks be prevented? This is an unknown. As we know, geopolitical tensions are rising, and this geopolitical risk is set to boost risk aversion. Going back to what is the wider geopolitical implications, well, all we need to do is look at the global economy. World growth is predicted to hit 3.2%. At the same time, OPEC have already downgraded demand for crude due to, the unfavorable global conditions. So when we add volatile oil prices to the mixture, there's concerns rising that this could result in a global recession. It's too early to come to any meaningful conclusion, but the impacts are negative. Going back to the euro dollar, I still see the euro dollar being capped below the 1.100 level. So last week, the euro weakened against the dollar, and almost every single G10 currency after Mario Draghi did whatever it takes to support the Eurozone economy. However, many do not feel that this is not enough. This is not enough to support the Eurozone economy, and the ECB was not as dovish as markets expected. This is why the euro is still trading around the 1.100 regions. Now, moving forward, I feel what would determine where the euro dollar trades is not only the developments happening in Europe, but more the dollar's valuation. So if the dollar finds support from reducing speculation over the Fed cutting interest rates, this will result in the euro dollar pushing higher. However, if the dollar starts to strengthen, this may push the euro dollar lower. I am going to load the charts later to fully to have a graphical representation of what I'm discussing. Now, with gold, will gold remain above 1,500? Last week, it was a struggle for gold prices to push higher. But looking at things now, gold was trading above 1,500 this morning. Now, what will determine where gold concludes this week will be number one, how markets continue to react to developments in Saudi Arabia. Number two, the stance the Federal Reserve, the Bank of Japan, and Bank of England take during the policy meetings this week. And number three, the overall market mood. Gold, as we know, is a safe haven asset, and in times of uncertainty tends to shine. So all we need to do is see the Fed expressing concerns over the US economy and suggesting deeper rate cuts, or geopolitical tensions accelerating the flight to safety for gold to push higher. Okay. Does anybody have any questions before we go on to the charts? So I've got loaded. Okay, so I've got two questions. So one from Fikil Gabriel about fundamentals. Yeah, so we've spoken all the fundamentals. Now we're going to move to the fun stuff, the technicals. So I'm just loading my charts, if everybody can see my charts, and we could discuss the technicals for the week ahead. And for Mr. Aftab, we are going to talk about the dollar CAD because, especially with what we've seen with oil markets, uh, we can't ignore how this is going to impact commodity currencies with the dollar CAD falling into the category. So I have the euro dollar loaded. So this is going back to what we're saying about is the euro dollar cap below 1.110. So just purely focusing on the technicals. Euro dollar is expecting a bearish trend on the weekly charts. There've been consistently lower lows and lower highs. Prices are trading within a weekly bearish channel. There seems to be a strong level of resistance forming around 1.1100. A breakdown below this, a breakdown below 1.100 should encourage a decline towards 1090 in the short to medium term. Now, for the euro dollar to push higher, there's two things that need to become reality. Number one, we need to see a solid breakout above the 1.1100 resistance. Or number two, probably a change in the fundamental landscape in Europe. So if we do see signs that Germany's economy improving, the manufacturing sector breaking away, rebounding back to expansion, political risks in parts of Europe cooling, this is seen boosting appetite for the euro. But as long as these themes remain present and market speculations are rising over the European Central Bank, easing monetary policy to support the Eurozone economy, the outlook for the euro against the dollar and most other G10 currencies remains bearish. Also, I've got a chart loaded on a pound US dollar on the weekly time frame. So last week there was this sense of optimism that, hold on, the United Kingdom may not be heading for no deal Brexit, and there could be an extension all the way to January 2020. This burst of optimism boosted appetite for the British pound, which appreciated against the dollar and every single G10 currency last week. However, nothing much has changed. There's still this thick layer of uncertainty over Brexit developments and what it means for the UK economy. Now, yes, there is a Brexit bill that has been passed which prevents a no-deal Brexit on October the 31st, but this concerns over Boris Johnson following the bill or other types of uncertainty, just coming into the picture is going to continue weighing on the British pound. Now, this week, Boris Johnson is set to face the Supreme Court. The outcome is uncertain, but whatever happens, it will certainly have a profound impact on the British pound. So I've got the dollar yen loaded on the daily charts, and this goes back to what we're saying about how the dollar yen is a great track of the market mood. Now, this renewed trade optimism is weakening demand for the Japanese yen, conversely pushing the dollar yen higher. Dollar yen does have scope to extend gains based on the fact that trade optimism and receding global growth concerns should reduce appetite for the Japanese yen. But longer term, though, I still think the Japanese yen will remain a trader's best friend, and especially if trade developments or trade uncertainty make an unwelcome return. Let's see how the high-level trade talks between the United States and China conclude in October. Looking at commodities, as we can see, gold is trading above the 1,500 level. I mean, the reason why gold is back in fashion is due to the geopolitical tensions that are fueling risk aversion and supporting appetite for safe haven assets. Okay? Naturally, where gold concludes this week will be influenced by the Federal Reserve. We know that the Fed is widely expected to cut interest rates, but I think what is important is what Jerome Powell says during the press conference, and if the central bank offers any clues to what they're going to do beyond September. We know the relationship between gold, the dollar, and interest rates. Gold is a zero-yielding asset, which tends to perform quite well in a low interest rate environment. So signs of the Federal Reserve cutting interest rates deeper will not only weaken the dollar, but boost appetite for zero-yielding gold. Technically, prices are above 1,500. Risk aversion should push gold prices to 1,525 and possibly 1,550. Now, if 1,550 proves to be an unreliable support, I'll be looking at 1,485. How can we not talk about crude oil after the explosive moves seen earlier this morning? Now, the main major driver why oil prices are so bullish right now is because there is the speculation that the disruptions could cause oversupply to turn to undersupply. Initially, the dynamics that have been influencing oil markets were demand side, but now they may shift to supply side factors. Outlook for oil is turning bullish, and I'll be looking at $60 as the first key point of interest. Above $60, 60.90 and 63.80. Okay. Now let's talk about the dollar CAD. So loaded, I've got a chart of the dollar CAD. I would have expected more from the dollar CAD given the intensity of the move witnessed in oil markets. So we know the relationship with the Canadian dollar and oil prices. You know, Canada is a major oil exporter because it produces oil. So when oil prices appreciate, the Canadian dollar appreciates. So really what we would have expected was the sharp jump in oil prices to boost Canadian dollar bulls with a renewed sense of inspiration. The dollar CAD is still trading around 13255. This is the daily charts. Really, if oil prices were to push higher, this should result in a dollar CAD trading lower. So I'll be paying very close attention to how the dollar CAD acts above the 132. Naturally, just a breakdown below 132 is seen open a path back towards 1309, 1310. Okay. So just to recap with what we're discussing, the four setups in mind: WTI crude position for further gains based on geopolitical risk. Euro-dollar cap below 1.100. As I said, the technicals are lining bearish in the weekly, but we need to pay close attention to fundamentals. Will gold remain above 1,500? This depends on the Federal Reserve policy decision later in the week, geopolitical tensions in the Middle East, and of course the overall mood across markets. And the currency spotlight was the dollar CAD. Sustained weakness below the 132 as discussed should open a path back towards 1310. Okay. So it is a big week ahead for markets. If anybody has any questions in regards to what we've discussed, please be free to ask away. For those who missed the earlier parts of the webinar, you can watch the recorded version of my FXTM. Also be free to reach out to me on Facebook. My name's Lukman, or Twitter, Lukman_FXTM. So thanks again, ladies and gentlemen. I'm wishing you all a happy trading week, and I'll see you all in 2 weeks.